Hello and welcome back. I know your exams are just around the corner, and for a lot of you, this chapter, Money in Banking, can feel a little heavy. But trust me, we're going to make it super simple. By the end of this quick session, you'll have everything you need.
So first things first, namaste pyare bachcho. Welcome back. And listen, tension nahi lene ka. This chapter looks tough, but it's actually one of the most interesting and logical ones. We're going to fly through it, and you'll get it, I promise.
All right, so here's our game plan for the next few minutes. We'll start with the Old Barter Problem, then see how money came in like a superhero. After that, we'll talk about the big money makers, the banks, and some money multiplier magic. And finally, we'll see how the RBI is the boss of everyone. Ready? Let's do this! Okay, let's start with a little imagination game. I want you to picture a world with absolutely no money. No cash, no Google Pay, no UPI, nothing. So, how do you buy stuff? I'm sure you've done this, right? You've got a Lou Protha in your tiffin, your friend has Maggie, and you guys do a little swap. That is exactly how the whole world used to work. This system of just trading things for other things had a name.
It's called the barter system. Now, for your exams, you can also use the fancy term CC economy. That just means commodity for commodity. Simple, right? But, this system, it had a really big problem.
And the biggest problem was this thing called the double coincidence of wants. Sounds complicated, but it's super simple. It means for a trade to happen, not only do I have to want what you have, but you also have to want what I have at the very same time. So imagine a farmer with a sack of rice who needs new shoes. He has to find a shoemaker who doesn't just have shoes, but who also wants rice. What if the shoemaker wants a new pot instead? The poor farmer is stuck. It was just so difficult.
So, this complicated world desperately needed a hero to solve this massive headache, and guess what? That hero was money. Let's see exactly how money saved the day.
So, what even is money? It's just anything that everyone agrees to accept as a form of payment. It's a commonly accepted medium of exchange. All of a sudden, our farmer doesn't have to look for a shoemaker who's hungry for rice. He can just sell his rice to anyone for money, and then take that money and buy shoes from any shoemaker. Problem solved. That whole double coincidence of wants thing, gone.
Now listen up. This is a very important exam question. The three main functions of money. Number one, it's a medium of exchange. We just talked about that. Number two, it's a unit of account. It gives a common value to everything, right? This pen is 10 rupees, that notebook is 100 rupees. It makes it so easy to compare. And number three, it's a store of value. You can't exactly store tons of rice for 10 years. It'll go bad. But you can store money. You can save it, put it in a bank, and use it way in the future.
Speaking of banks, where does all this money we use today come from? Who's in charge of it all? Well, that brings us to our next topic, the big money makers of our economy, the commercial banks.
The actual business of a bank is really simple when you break it down. They do two main things. One, they accept deposits from people like you and me who have some extra cash. And two, they give out loans to people who need to borrow money. They pay us a little bit of interest for our deposits, and they charge a higher interest on the loans they give out. And that difference in interest, that spread, well, that's how they make their profit. Simple. Your textbook has this great little story about Lala the goldsmith that explains this perfectly. So imagine a village where everyone used gold. It's not safe to keep gold at home, right? So everyone started giving their gold to Lala for safekeeping. In return, Lala gave them paper receipts. Pretty soon, people just started trading with these paper receipts instead of actual gold, because everyone knew that each receipt was backed by real gold sitting safely with Lala. Now here's where Lala got really clever. He had this big aha moment. He noticed that not everybody came to take their gold back at the same time. In fact, most of the gold was just sitting there in his vault, doing nothing. So when Ramu came and asked for a loan, Lala thought, why not, and lend him some of the gold? And that right there, that's the basic idea behind all of modern banking.
And this simple idea that Lala had leads to something that seems like pure magic. It's how banks can literally create money, seemingly out of thin air. This is called the money multiplier, and let me tell you, it is a super important topic for your exams.
But hold on, can banks just lend out all the money people deposit? Nope. There's a big boss, the RBI, that sets the rules. And one of the most important rules is the cash reserve ratio, or CRR. It's just a percentage of all deposits that every single bank must keep as a reserve. They are not allowed to lend this part out. This is the rule that controls their magic power to create money.
Let's just walk through a quick example. Let's say you deposit 100 rupees in a bank, and the CRR is 20%.
Okay, so in round 1, the bank has to keep 20 rupees aside as a reserve. It can then lend out the other 80 rupees. Now that 80 rupees, which was loaned out, gets spent and it ends up being deposited back into another bank. Now that bank keeps 20% of the 80 and lends out the rest. And this cycle just keeps going and going, creating more and more money in the system until that first 100 rupees has actually created a total of 500 rupees in the economy.
So here is the secret magic formula, and it's so simple. The money multiplier is just 1 divided by the CRR. That's it. So if the CRR is 20%, which is 0.2, the multiplier is 1 divided by 0.2, which equals 5. This means every single rupee of new deposit can create up to 5 rupees of total money. It really is like magic, right?
Okay, so if all these banks are creating money, who's in charge? Who makes sure they don't go crazy and create too much or too little? Well, that's where the final and most powerful player in this whole story comes in. Let's meet the big boss.
And that is the Reserve Bank of India, the RBI. The RBI is our country's central bank. Think of it as the banker for the government and the bank for all other banks. It's the one that prints our currency notes, and most importantly, it controls the entire supply of money in the country.
So how does it control the money supply? Well, it has a whole toolbox of powerful instruments. It can change interest rates, it can change those reserve ratios we just talked about, but for this quick revision, let's just focus on one of its most powerful tools: Open Market Operations, or OMO.
Open market operations is just a fancy name for the RBI buying and selling government bonds. And the logic is really, really simple. When the RBI wants to put more money into the economy, it buys bonds from the banks, and in return, it gives them money. So money supply increases. And when it wants to take money out of the economy, it sells bonds to the banks and takes their money. So money supply decreases. It's not direct.
Okay, quiz time. Let's try a typical exam question. This could easily be a 3-marker. So, if the initial deposit in the banking system is 1,000 rupees and the CRR is 25%, what is the total money supply created? Go on, pause for a second and try to solve it with the formula we just learned.
Did you get it? Let's check. Okay, step 1. Find the money multiplier. It's 1 divided by the CRR. So, 1 divided by 0.25, which is 4. Step 2. Multiply the initial deposit by our multiplier. So that's 1,000 rupees times 4. And the answer is 4,000 rupees. If you got that right, high five. You just nailed a potential board exam question. Simple, hai na?
And just like that, we're done with our super quick revision. We've covered the whole story, from barter all the way to the RBI. So I'll just leave you with one final thought. We've gone from trading goods to gold to paper money, and now we live in a world of UPI and cryptocurrencies. What do you think money will look like in the future? Something to think about. All the very best for your exams. You guys are going to be fantastic.